Hi, I'm Todd Rosenbluth, Head of Research at Vetify, and thanks for joining us for another episode of ETF 360. Today I'm joined by Michael Natale of FlexShares, and we're here to talk about QLV. Michael, thanks for joining me.
Thanks for having me, Todd.
My pleasure. So we've had a very volatile year in 2022, but we've seen lower risk securities hold up considerably better. Advisors and investors are turning to these securities. Why do you think that's the case?
Well, Todd, anecdotally, when the market becomes more volatile, we see a flight to quality and a flight to lower volatility names. And I suspect that many of us, if not everyone listening today, has experienced this themselves as well as on behalf of their clients. But empirically, we see this trend holding as well. Lower volatility tends to do better in periods of uncertainty. I think that's fairly obvious. But let's categorize that in terms of macroeconomic regimes or cycles. And then we can talk about this in terms of factors. So in a slowdown or a contractionary period, we see the low volatility factor perform particularly well. Now, low volatility tends to underperform in markets that are recovering strongly, but I think we can all agree that's not where we are right now. So the low volatility factor outperforms over a full market cycle. And it's because of this outperformance and slowdowns and contractionary periods. So long story short and better stated, now is the time to own low volatility.
So Michael, what are the benefits of combining quality and low volatility in the same portfolio?
Yeah, Todd, so there's several reasons. But first, let's start by following up on the factor performance discussion that we just talked about. But we see quality as a factor that outperforms historically in all segments of the macroeconomic cycle. So that's slowdown, that's contraction, but that's also recovery and expansion. So quality as a factor has historically been a strong performer in all parts of the cycle. So better stated, quality are like all-weather tires. But second, we need to talk about what happens when you combine quality with another factor. Obviously, in this case, we're talking about the intersection of quality and low volatility. And our research at Northern Trust shows that when we combine quality with low volatility, it smooths out factor cycles, allowing to not only enhance performance, but also to reduce risk. So remember earlier when I mentioned that low volatility may perform less well or underperform in a recovery and expansionary period? Well, adding quality, that helps to mitigate that issue. So finally, let's talk about the relationship of quality and low volatility. And this is where it gets a little tricky, so stay with me. High quality and low volatility are not necessarily that highly correlated. But low quality and high volatility, they sure are. And so by avoiding low quality names, we could further reduce volatility and enhance returns.
Well, that makes a lot of sense. So FlexShares has one of these ETFs, QLV. Tell us about it.
Sure. So we actually have a suite of products in this space. So we have the QLV suite, which is quality and low volatility, QLV. And we have three distinct products across three different segments of the world. So you've got domestic, which is QLV. You have developed ex-US, and when we say developed, we mean world ex-US, not just EFI. That's QLVD for developed, and then QLVE for emerging markets. So you can get exposure to quality and low volatility across the globe in three separate tickers. Now, we build on the research that I summarized previously by investing in high quality, low volatility names. And the goal is to build a portfolio that eliminates the lowest quality names, which I noted earlier, and it helps to reduce volatility and enhance returns. So that focus on high quality names in the low volatility universe, that's the dynamic combination. But here's the most important part about the QLV suite at FlexShares. We want to put control mechanisms into these portfolios. So we're firm believers that you do not want to take on risk that you're not compensated for, right? Uncompensated risks, unintended bets, not good things in portfolios. And so what we do is limit the amount of exposure to individual security names. In the developed and emerging market products, we limit the country exposure, but most importantly, we limit sector bets. So that way we provide a sector neutral product that is easily slottable into portfolios.
So how do you see advisors using this quality, low volatility suite of products as a replacement to their core portfolio, as a complement, or something else?
Yeah, Todd, good point. So we see it as both. You could have it as a core. And if we think about where we are today, and today being that operative word, I would say that many advisors that we're talking to feel that we're on the cusp of a potential recession, if we're not already there. And if you believe that this is the case where we are and that we could even see even more downward pressure, low volatility makes a lot of sense right now. And if we look at history, while overall average volatility is lower than pre-global financial crisis levels, those shocks of volatility are much higher. So we're feeling them not as often, but we're feeling them much more.
I certainly see how that makes a lot of sense, and that's great insights, Michael. Thank you for the insights, and thank you everybody for tuning into ETF 360. We'll see you next time.